Tech earnings are expected to grow 30% this year. That is the figure circulating across Wall Street desks, cited in earnings previews, embedded in analyst price targets, and used to justify valuations that still sit well above historical averages. On a day when the S&P 500 slid nearly 1% as Iran war fears pushed crude oil above $112 a barrel, the broad tech earnings story was offered as a counterweight. Fundamentals remain intact, the AI build-out continues, the cycle is not broken. The market consensus held the 30% growth figure as evidence that the sell-off is noise, not signal. James Lebenthal said something different this week. Strip Nvidia and Micron out of Q1 S&P earnings, and overall tech earnings growth drops to roughly 3%, not 30%, 3%. That is not a rounding error. That is a tenfold difference between what the headline says and what the underlying index is actually doing. Google, Apple, Microsoft, and Meta, the four largest tech companies by market cap outside of Nvidia, are posting what Lebenthal called unimpressive Q1 earnings growth. The headline number flatters a picture that is underneath quite thin. The error is in the aggregation. When analysts say tech earnings are growing 30%, they mean the sector as a whole. But Nvidia alone delivered full-year FY 2026 revenue of $215.94 billion, up 65% year-over-year, with net income of $120.07 billion. Q4 printed $68.13 billion in a single quarter. Data center revenue was up 75%. Data center networking was up 263%. Jensen Huang's line from the earnings call, "The agentic AI inflection point has arrived," was not hyperbole. The numbers backed it. Micron contributed the other half. Fiscal Q1 2026 revenue came in at $13.643 billion, up 57% year-over-year. Gross margin expanded from 38.4% to 56% in 12 months. Q2 guidance called for $18.70 billion in revenue, nearly double the Q1 EPS in a single quarter. 2 companies, 1 sector number. The math works, the inference does not. What the 30% figure does not tell you is that Apple is down nearly 5% today, not because of earnings, but because Nikkei Asia reported engineering setbacks in the foldable iPhone timeline that could push the product into 2027. Microsoft is now the biggest deadweight on the S&P 500. Meta is showing what analysts describe as unimpressive growth against elevated comps. ARM Holdings fell today. The broad tech basket, ex-AI infrastructure plays, is not growing at 30%. It is growing at approximately the rate of the overall economy. The 30% figure, in other words, is not a sector story. It is a 2-stock story being read as proof of sectoral health.
If the earnings concentration is this extreme, the risk profile of the S&P 500's tech weighting changes materially. The index is effectively levered to 2 companies. Nvidia's Q1 FY 2027 guidance calls for roughly $78 billion in revenue, and that figure explicitly excludes any data center compute revenue from China, a caveat that sits quietly in the footnotes while the headline revenue number drives valuations. The Fed is not helping. Chicago Fed President Austin Goolsbee said Tuesday that inflation will come roaring back, calling the oil price surge a stagflationary shock with no obvious policy response. The New York Fed's survey of consumer expectations showed one-year inflation expectations rising to 3% in March. WTI crude is up 70% in 26 trading days. If oil stays elevated and the Fed holds rates, or raises them, the multiple compression case for the other 498 S&P stocks gets harder to dismiss. The market is pricing the 30% growth story as if it distributes across the sector. It does not. It concentrates in 2 names that are both supply-constrained, geopolitically exposed, and now trading below recent highs on war-driven risk appetite. Nvidia is down 20% from its record. If either Nvidia or Micron misses Q1 estimates, earnings begin at the end of April, the headline growth rate collapses before anyone has time to recalculate. The weight of evidence points toward a market that is more fragile than the 30% headline implies, but that fragility only becomes a catalyst if Nvidia's Q1 print, expected in late May, falls short of the $78 billion guide. If it beats, the 2-stock thesis holds for another quarter, and the broader sell-off may look like an entry point. If it misses even modestly, the 30% becomes 3%, and the sector repricing has room to run. Watch Nvidia's guidance revision, if any, between now and the print. A downward revision would be the cleaner signal. An upward revision would extend the thesis, but it would also concentrate the risk further.